Hi everybody, this is Nicole Vanderstorm again and welcome to my next class lecture, which is going to be on chapter 5, which is all about merchandising inventory or merchandise inventory. Now folks, at the outset, this is just a summary highlighting some of the more difficult concepts to help you through them. This is in by no means a complete lecture. You still need to go and follow my tips for success in the Start Here tab of your Blackboard module, which is on the left-hand side. And in those tips, I tell you and I give you a guide of exactly what steps you should be taking to learn this material to such a degree that you can have a strong understanding and perform well, not only in exams, but also in homework questions and assignments. All right, folks, so let's have a quick overview about merchandising inventory. What we've done between now, up until now with Module 1, is we learned about a service business, right? A service entity. Now, we take it one step further and we look at entities that actually sell inventory. Now, these are called merchandisers, but you get two types of merchandisers. You get a retailer, pretty much your Walmarts and your JCPenney's and your Macy's and your Neiman Marcus's, right? Those are retailers because they sell directly to a customer. A distributor, however, stands between a retailer and the manufacturer, and they would distribute to multiple retailers. But the business model is still the same. What's happening is they're purchasing inventory and then they're selling it with a markup in order to cover the expenses and also generate a profit. All right, folks. So when looking at merchandise inventory, I'm going to just give you a little simple overview of how I see it. And again, I just want to remind you that this is not a replacement for the lectures that I have posted that were given by Professor Jerry Simpson. All right, guys, so let's look at our T account. All right, so the first thing that we're going to see on this T account is merchandise inventory, and it's an asset, right? And we know it's a current asset. Why? Well, firstly, we know it's a current asset because it's going to be lasting us for less than a year. And furthermore, we know it's an operating asset because we use this current asset to generate sales and actually make a profit. All right, folks, so let's talk about the components of the inventory part of the operating cycle. All right, guys. So first things first is that what happens is we have a purchase of inventory. Okay, so we're just going to say purchase. All right, so that's going to be a debit to your inventory. Okay, I'm going to call it merch. Okay, so that's going to be a debit to your inventory and it'll be a credit to your accounts payable. All right. Now, as you go through this, and we know in real life that what happens with purchases is that sometimes we find that either the wrong items were delivered or that the quality is so poor that we cannot use it. Now, we would have what we would call a purchase return. That's where the goods are actually accepted back. So, goods sent back. But sometimes our suppliers say, you know, it's going to cost us too much in shipping. How about we give you a discount? Because, you know, you could still use the stock for something or the inventory for something else. So how about we just give you a discount and, you know, you consider it done. So that's called a return of rights. All right, folks. So when we actually return goods, there's a whole lot of processes and internal controls, very similar to the goods received, note, and delivery process. When we return the goods, we would issue what we would call a goods return note. Okay, and the storeman at our supplier would be the one checking that the quantities actually agree with what's on the goods return note. Okay, so it's going to be either or. You either get a purchase discount, you either get a return allowance, or you get to return your purchases. So it's always either or. So those two are considered as either or. One of those can come through. All right. The next GL line item talks about the cost of freight. Okay. Now we're going to call this freight in. And now, folks, what I just want to warn you about on this is that freight in is considered to be a component of the cost of, sorry, I'm just going to turn off this annotation. All right, so we have freight in. Okay, guys, now what's really important to understand is that freight in is actually the cost of shipping the goods that you buy to yourself. Okay, so let's talk about this. A freighting cost would only arise if it is, let me just look at this. All right, folks, so we get two types of freight costs, right? The first type is where the customer pays for the freight, right? And the freight that the customer pays for is called FOB shipping point. FOB shipping point. All right. So that's the freight that the customer pays for. So it's FOB shipping point. FOB, by the way, stands for freight on board. Okay, so FOB shipping point. Actually, it may be free on board as well, but it basically means the same thing. Okay, so it's freight on board shipping. So that means that when the item is shipped, when it leaves the dock of the supplier, it becomes the customer's responsibility. Okay, and that means the customer has to pay for the shipping, and also the risk passes to the customer the moment it leaves the supplier's dock. Okay, when it comes, so it's only going to be FOB shipping point that would be considered to be a freight in cost. All right, folks, and now just to show you, there are actually two types of freight costs. Okay, I'm just going to set the slide up for you. All right, folks. If you have a look, you have two types of freight, right? You have your shipping point. You know what? I think what I'm going to do is I'm just going to copy and paste this little picture here. All right, guys, let's take a look at this thing. I just really want this to be inside. Give me a moment. You know what? I'm just going to put it on the next page so I can show you. All right, folks. So let's just put it here. All right. And let me just take off these annotations. All right, folks. So now we have two types, okay? So I've already told you that the freight shipping point is actually paid for by customer, okay? Now, what's the point here? Well, it's paid by customer, and it becomes the customer's responsibility, right? Actually, it says here, the minute that it leaves, see, the minute it leaves the seller's premises, it becomes the customer's responsibility. So the minute it leaves the seller's premises, okay? So what this means, you know, is that the seller is no longer responsible, but the buyer is responsible. And a lot of times we see this example, for example, where large shipments of oil are shipped in from overseas and large supplies of goods are shipped in from overseas. And what would happen is that the buyer would be spending a lot of money on insurance, not only the insurance in respect of the currency dropping, and therefore less money being received, or alternatively, it would be insurance for the actual goods in case there's a tornado or a hurricane. So in case there's a hurricane that causes the ship to sink, or a tornado that causes the truck to overturn and damages all the goods. But, you know, you would find that the customer would insure for the shipping point. Okay, folks? Now, destination. Guys, this is where the customer is only responsible when the goods are delivered to the door. Now, who is a great example of that? Amazon, right? Because, folks, what happens with Amazon is, especially if you're a Prime member, you normally do not pay for shipping, right? And it only becomes your problem when you receive the goods. Think about it. If you don't receive the goods, you're able to write to Amazon and say, hey, I didn't receive my goods, reship it or give me a refund. Now, folks, the way I remember it is that I am destined to shop at Amazon. I love shopping at Amazon, and that's how I remember my example. So FOB destination will be like the Amazon. Obviously, it's not going to be a cost that's going to influence our general ledger, right? Or our T account for merchandise inventory. Okay, folks? All right, guys. So again, we're looking at the inventory. Let me pull up my T account again. And I'm just wondering where it went. All right, so let's go back to our T account, and I'm going to clear all drawings again. Okay, so we're talking about shipping. Now, folks, one thing I need to tell you is that when it comes to selling inventory, okay, and you're paying for shipping costs when it's a sale, I'm just going to put your sales side, okay? Cost of shipping is considered, it doesn't go to your gross profit or to your cost of sales or to your revenue. Cost of shipping goes to your sales and to your sales costs. Okay, and if you recall on an income statement, your sales cost is actually going to be part of your sales cost is actually going to be part of your SA&G. Okay, sales cost is part of your operating expenses over here. Okay, so the place that you would put costs to actually deliver the goods to your customer will actually belong right here. Looks like I'm not sharing the right screen, so let me share the right screen. All right, folks, let's just go over that one more time. All right, so the way that I remember my freight is, and the cost of my freight is that I think FOB destination, I'm always destined to shop at Amazon, okay? So that's the way I remember which one is FOB destination and which one is FOB shipping. Now, an example, a good example of FOB shipping would be Etsy, right? Items are custom made and you have to pay for the shipping. If the stuff doesn't arrive, it's your problem and not the Etsy provider's problem, because they're going to ask you to pay again to make a custom product that you would be ordering. All right, folks, so just remember, I am destined for Amazon, and that's my FOB destination. This is something, it does not impact us, right? So no GL entry, no journal entry for this, okay? No journal entry for FOB destination because the supplier is paying the shipping costs, right? There's definitely going to be a journal entry for FOB shipping point because as soon as it leaves the premises, it's our problem. So definitely a journal entry here. Okay. All right, folks, apologies for that. I hope that you all got that. All right, let's go back to where I was when I realized I wasn't sharing the right screen. Okay, so if I go back to my T account, okay, so now we know that our costs are going to be our purchases, which is going to increase our inventory, and our freight in. We're not going to debit the income statement, we're going to debit the cost of the inventory. Okay, now just a reminder that when it comes to the sales side of things, remember the sales side is going to be opposite, right? When you actually pay to ship products to the customer, so sales and shipping, this actually does not affect your costs in any way. All right, it doesn't affect your inventory in any way. It's actually processed to sales expenses. If you guys remember with our income statement, what we did was we had our service revenue, okay, and then we also had our operating expenses, and that in turn gave us our operating profit. Let me show you an income statement just so that we can refresh our memories. 1 second. Okay, folks, so if you remember, and if we refer back to those lectures where this was discussed, we're talking about our SAG over here, which is part of our operating expenses, okay? Which is SAG, which is going to be selling expenses and admin expenses and general expenses, right? SAG. All right, folks, and that in turn will be disclosed under here and part of operating expenses, okay, over here. You can ignore this for now, at least this part. I'll show you the differences between the two income statements later in the lecture. But I just wanted to remind you what a selling expense is that it's part of your operating expenses. All right, folks, so let's just clear that up. All right, now there's another really important piece that we have to talk about. And this is what impacts your cost of your merchandise inventory, or the value of your inventory. And that is going to be your discount. Okay, it's called a trade discount or a settlement discount. Now, folks, when I talk about a settlement discount, what happens is that company offer settlements for you to pay quickly. It's a way that they actually get their cash flow to be running at an optimal level, and they can turn the cash flow faster. And the way that a settlement discount is described is that it's going to be percentage for days. Okay, so if I say 3-15 or 3/15, it's going to be percentage. So I get a 3% discount if I pay within 15 days from either the date of the invoice itself or the date of statement. Now remember that they can both differ, okay? So if I pay within 15 days, I actually get a saving, all right? So that settlement discount will hit the merchandise inventory account, okay? Now let's say you don't pay it on time. Well, you've gone and forfeited a discount, and that's going to increase your cost of your merchandise, okay? Now, also, the way it would be worded is 3-15 and then net 30. What does net 30 mean? Net 30 means that the full amount is payable 30 days from the date of invoice or from the statement date. So it just depends on your supplier's terms which one is applicable. So remember, it could be 4/10, 4% within 10 days, net 30, maybe net 60. Okay, so it just depends. So that's how we determine our settlement discounts. This is the special disclosure that we used. Now, folks, when it comes to the sales side, what I also need to tell you here on the sales side, okay? what you recognize is you recognize that you reduce the sales by the settlement discount offered. Okay? And if someone doesn't pay the settlement discount, then it's just going to be forfeited settlement discounts. So forfeited discounts treated as other income. Okay? It's not going to be part of your cost of sales. So that's what you must remember on the sales side, and you will see that discussed in detail in the presentation. All right, folks. So pretty much these are the 5 transactions that hits our general ledger account. Okay. So at the end of the day, it's going to be all the debits and all the credits that are going to determine what our closing balance is, and that is what's going to be sitting on the income statement. Now, folks, there is another piece here, okay? And the piece here that you must also remember is that when a sale happens, okay? So let's say a sale happens. All right. When we recognize a sale happening, we're going to have to credit purchases and debit cost of sales. I mean, we're going to credit merchandise inventory and debit cost of sales. Okay, so let's go back. So when we do a sale, so we call it sales. So remember, that's going to reduce our inventory as well. Okay, and then our net balance, of course, or our closing balance, of course, is going to be the difference between the two biggest side wins. Normally, you should have some sort of closing stock, right? Okay, so this is exactly how the GL works. Now, remember the 3 exceptions when it comes to sales. So the sales will pretty much look the same, except that your freight out is treated as a sales cost. So it's an operating item. It doesn't affect your cost of sales, right? Any settlement discount is treated as part of your sales price. And if people forfeit those settlement discounts, then those settlement discounts are treated as other income if you are the seller. And also, the other component is that on the sales side, what you would be doing is you would be debiting cost of goods sold, COGS, and you would credit merchandise inventory. Folks, what on earth am I talking about here? Well, cost of goods sold is pretty much the cost of the purchase of the inventory, right? So it's kind of like, it's going to be all the costs in respect of those units that you've gone and sold, okay? So really, cost of sales is actually calculated as follows. And I want you to always remember this equation, especially if you're going to be doing accounts 2 with me, because accounts 2 is going to really talk to this, all right? So folks, cost of sales, I need you to always remember this equation for the rest of your accounting careers, all right? So, cost of sales or cost of goods sold. I'm just going to say cost of sales because that's what we're doing in this class. Let's make the font bigger. All right. Cost of sales works like this. Opening stock plus purchases plus freight in minus discount or return allowance less closing stock, so minus closing stock, is going to give you your cost of sales. Okay, so folks, remember this equation. This equation is going to be so important to you. So learn this equation off by heart and put it in your cheat sheets. Okay, so guys, what do you see here? Do you see these entries over here? See these entries over here? Don't these look like the T account in merchandise inventory? Absolutely, they do. Because that's what's used to calculate your cost of sales. Your cost of sales is calculated using the amount of inventory at its cost that gets credited to the merchandise inventory account when an item is sold. Okay? So if we look at our cost of sales, it consists of opening stock plus purchases minus plus freight in minus returns minus allowances minus settlement discount. Okay? And then it's going to also be minus your closing balance, which I already showed you earlier on. So let's just say minus closing balance over here. Right, so do you see how these all tie in? Okay. So now what's a really important point to make here is that something very similar happens over here that we have seen with regards to our fixed assets and depreciation. All right. So let me clear these annotations quickly. Let's have a quick look at what I'm talking about. All right, folks. So now, as you recall, when we were looking at fixed assets, right, we looked at the balance sheets. And look what we did. We had an account for cost of fixed assets, so it was fixed assets at cost. All right. And then it was less accumulated depreciation. Goodness, my spelling, sorry. Okay, less our accumulated depreciation gives us the book value. Okay, folks. So if you recall, book value, there's no such thing as a book value T account or general ledger in our accounts. Okay, so this very similar thing happens on the income statement when it comes to merchandising, merchandises, is that what we have is we have a line item called sales, okay, rather than service revenue, so it would be sales revenue, all right, less cost of sales, all right, and that's going to give us a very important line item called gross profit. Now again, folks, there is no GL account called gross profit, okay? It's just a disclosure in the income statement. All right, so this means that every time there is a sales transaction, instead of just having one journal entry, you're going to be having two. So the first piece, okay, is going to be this. If you think about what we did in chapters 1 to 4 on the service industry, right? Service business. The only thing that we did in chapters 1 to 4 was we would debit cash as an example, or our accounts receivable. All right, and then we would credit, service revenue. Okay, so it was just one journal entry for the sales when it came to a service business. Okay, folks? But now when it comes to a merchandiser, okay, we're dealing with inventory. So let me change the color for you. Okay, and what's going to happen, let's make it a cool color. Let's make it bright purple. All right, so with the merchandiser, so chapter 5, we're going to have 2 journal entries. First of all, what we're going to be doing is we're going to be debiting bank. All right, so let's just say we're doing a sale for cash, or debiting bank or accounts receivable. Okay. So first of all, we're going to recognize the sale. All right, so we're going to debit the bank or accounts receivable, and then we're going to credit sales revenue. All right, and then the second step of the process is that we have to take the inventory out. Take inventory out. Okay, so that's going to be our second journal entry. And what that's going to look like is going to be a debit to cost of sales. Okay. So you're going to debit cost of sales. And then what you're going to do is you're going to credit merchandise inventory. All right, so let's just remember this. So there's 2 steps to our journal entry. Every time we do a sale, the first one is that we're going to recognize the sale, and then the second one is that we are going to take the inventory out with a separate journal entry. So folks, what that does is that leads us to a slightly different format for an income statement. Okay, so just to show you, I'm just going to put it on a better view. So if you have a look, if you are looking at your income statement, what you will find is that in the past for service revenue, you only had a line item for service revenue. Now you have sales revenue, less cost of goods sold, less gross profit. Less cost of goods sold gives you the gross profit. Okay. Now, why do you think we call this net sales revenue? The reason that we call it net sales revenue is after we've taken into account, so let me just put a text box here. It's because after we take into account all discounts, then we are left with our net sales revenue. That's why it's called net sales revenue, because it's after discounts. Okay. All right, guys, after discounts and returns, that's why we call it a net sales revenue. And we've already seen that in the journal, in the T account that I showed you earlier. So if you just want to go back and have a quick look, if you recall, what we said was that our net sales, okay, is going to be after our allowances and after our other expenses, okay? Because everything hits our after discounts that we offer to our customers, right? Remember, it's going to be showing on the flip side, on the opposite direction. Okay, so that's what looks so different, okay? And then cost of goods sold, remember, it comes from your merchandise inventory GL. Okay, so guys, also in terms of the balance sheet, there's a slightly different thing going on here. And that is that, let me just clear all these drawings. That is that we have another asset that we recognize on this set of financial statement, and it's the merchandise inventory asset, right? It's another current asset, okay? And it's less liquid than cash accounts receivables. So inventory is less liquid because it's going to take longer to turn inventory into cash than it would to collect our cash from accounts receivable. And why is that? Well, because normally our terms are 30 days for accounts receivable, But when it comes to inventory, it could be sitting in our stores for 2 months, 3 months, 4 months, worst case scenario, a couple of years. Okay, folks? So just remember that. All right, now I just want to work backwards, and I just want to talk about this journal entry. So let me just clear everything here for you so we can go back to the notes that I made earlier. So let's do that. All right, folks. So if you remember earlier on, I told you that your cost of sales, or that, no, earlier on I spoke to you about sales, right? And that when you do your sales journal entry, you're going to have two pieces to the process. You're going to recognize the sale by crediting your sales revenue and debiting bank, and you're going to take the inventory out. Now, the difference between these two, the difference between sales revenue over here and cost of sales, you see one's a credit, one's a debit. So your difference here is going to be gross profit, which is displayed on your income statement only. So remember that, guys. All right. Now, one more point. Folks, how do we determine the value of the inventory that we are selling? Okay. This cost amount for this cost of sales, it's normally something that is calculated separately. Okay. We don't just turn around and take totals. What's important about cost of sales is that it is based on quantity or units times it's going to be quantity or units times the cost per unit. It's a calculation, okay? All right, and when we go into chapter 6, we will talk about the complexities around calculating this cost per unit. Okay, folks, so this is what we're going to be discussing in chapter 6. All right. So what I would like you to do is really have a strong understanding of how your merchandise inventory T account is calculated. And then also a very strong understanding of the differences between the sales transactions that would be mirrored versus your actual inventory or your supply transactions as the buyer, okay? So seller versus buyer, and then understand that when it comes to freight in, it's only going to be a cost to you if it is FOB shipping point, okay? Because the risk passes to you as soon as it leaves the supplier's premises. Therefore, you're responsible for the cost of shipping as well as insuring the items, okay? And then also another point to remember is that returns and return allowances reduce the cost of our inventory, okay? And then we also reduce the cost of our inventory by settlement discounts. Now, I've also shown you what the acronym 3-15 means, okay? 3-15 net 30, 5-10 net 60, just means 5% within 10 days. Net amount is due at 60 days. So just remember that. And then also one last final point is to remember that shipping costs to your customers are not considered part of your sales revenue. It is considered part of your expenses, your selling expenses, okay? And then also we recognize net sales, which is going to be sales net of our returns. All right, so it's net sales, okay? Because we don't disclose sales and return items as separate items, okay? And there is also less discounts that we offer. And if a customer does not take that discount, that forfeited discount is treated as other income. All right, folks, so that's really a summary of exactly what the merchandising inventory part of the operating cycle looks like. And our next chapter, which is chapter 6, is going to talk about accounting principles as well as inventory calculations. All right, folks, I hope you have a great day and I will see you next time. Bye-bye.